Jeff, Journal has a piece about traders in the oil markets losing their faith in any kind of geopolitical rally. And I wonder if you can extend that to equities. It doesn't seem like geopolitics moves much of anything, at least in the short term.
Yeah, the language of the markets is really easy to interpret here. It's a classic, almost textbook response to U.S. military strikes. Unfortunately, we have more than 30 years of these military strikes to take a look at and see what the market's reaction is. And it's classic. In the first day, you see a modest but significant negative response. And then over the next 5 days, usually markets have fully recovered those losses. And that's where we are again. But, Carl, that's usually in a backdrop where the global economy is stabilizing or growing. And that's, in fact, what we're seeing. Global leading indicators are showing signs of upticks. Analysts are actually raising their earnings estimates for the first time in a year or so. This is all fairly good news, and markets, I think, are focusing on that, something they have a little bit more confidence in than the uncertainty associated with the fog of war.
Bob, I'm just looking here at the price of oil, and we are actually seeing it fall here by more than 2%. But we also did just get this unexpected rise in oil inventories, up 1.164 million barrels, and the market had been expecting that to come down 3.2 million. That seems to be moving things much more than what we had seen in the Middle East.
That's right, Courtney. You know, we're in a tug of war between bearish supply and demand fundamentals for oil, particularly in the first half of the year, with global surpluses well over 1 million barrels a day on the one hand, and then the surprise return late last week of geopolitical risk on the other. We've completely undone the premium that went in since the hit on Soleimani. So the market is erring on the side or going with the weak fundamentals for the moment. I think that's misplaced and complacent, but that's definitely where the market is right now.
Why do you think that's misplaced and complacent, Bob?
Well, my firm has a 1 in 4 odds that this rapid scampering up the ladder of escalation with Iran will lead to a general war. That's easily a $30 scenario, and 25% of $30, about $7.50. So we think we need to see about a $3 to $10 risk premium into crude. We think Iran, while continuing to stop short of killing Americans, because that would unleash that war scenario, which we don't expect, but still is 1 in 4, we think the market has some more risk pricing to do. Iran is not done. Last night, it made clear that countries that host U.S. bases are on the table for a retaliation. We think there's more to come, and that'll put more of a bid in crude. So geopolitics is coming back.
Jeff, it seems that the market does not believe what Bob is saying here right now, as we're holding on to some marginal gains. Even the price of gold just about flat to down at this point. Do you think the worst of the worry for the markets, at least, is behind us? We saw that huge drop in futures, and that seems to be well in the rearview mirror at this point.
Yeah, the markets are viewing this as a flare-up in a long-term conflict. And, you know, gosh, if markets waited for the all-clear of conflict in the Middle East, they never go up at all, right? So this is an environment where markets are focusing more on what they know. We're headed into the earnings season. That looks to be another environment where companies are likely to beat expectations. And again, even in the weakest part of the global markets, the manufacturing sector, we've seen things firm up a little bit. And I note on oil prices, gosh, if we saw another $30 jump there in the context of a very strong labor market right now and the supply situation in the U.S., it's hard to see the big negative economic impact that could tip us into a recession or reverse some of the stability we've seen in manufacturing or on the consumer side of the equation.
So at this point, Jeff, do you think multiples are just about right? Why would you bid on this market unless you, I guess you believe multiples have more to expand?
I'm not sure it has to come from multiples. I think for the first time in a year or so, we might see it in earnings. This year, earnings expectations are looking for maybe 9 to 10% growth. It could be a little optimistic, but still solid single-digit growth in earnings for the first time in a year or so could be good news. We could actually see it on the E instead of the P of the PE in terms of a market improvement. And that could set us up for a year where the economy looks better this year than it did last year, but markets maybe don't produce the same type of gains because it's not coming from valuation. It's coming from a more fundamental basis in earnings.
Bob, you know, on Twitter, Iran's foreign minister indicated that the action was sort of it. That was the end. They don't want further escalation. But if your firm is still pricing in a 1 in 4 chance of a war, what's the long-term risk? What's the next tipping point or catalyst that could see things change from where we sit right now?
Right. Well, the supreme leader, who is the boss of Zarif, the foreign minister, tweeted last night that last night's attacks were not enough. It's a slap in the face, but it wasn't enough. And the Islamic Revolutionary Guard Corps issued a statement last night saying, we're going after countries that host U.S. bases. So while we think Iran will continue to stop short of killing American officials and invading our embassies and so forth, because we learned that that gets a disproportionate response from President Trump. We think they're still going to try to eject the United States from the region by attacking facilities and bases and even oil facilities of countries allied with us in the region. And so we don't think the vengeance campaign, the revenge campaign, if you will, is over. It's just begun.